Welcome back, investors. Jake here. Today's video, let's check in on the stock market as the markets were red on Friday. S&P down 1.6, NASDAQ down 2.4. What exactly triggered this sell-off on Friday? We'll explain that in this video. But first, let's check in with the technical charts for the S&P 500. I think this is fascinating as I feel like this down channel is pretty much confirmed. This lower slope line has 1, 2, 3, 4 points of contact. I know with these charts you can kind of draw lines and see whatever you want to see, but to me this is pretty strong. I feel pretty confident at this point that trading algorithms and technical traders are using this lower slope line to buy and sell at certain points. Now, the upper trend line is a bit more wiggly. I've drawn it up here, but if you wanted to make this a tighter range, then that kind of changes when you want to buy and sell, because potentially we're now again at the top of the range. However, I think it's actually going to be up here, and the S&P over the next 2 weeks will once again touch this upper range, with the S&P potentially getting to 4,250. Why am I so bullish? I'll tell you in a sec. But what's going to happen after it touches the top of this trend line? It's just going to sell off again and create a new lower low. And we're heading towards this convergence point, which I'm feeling pretty confident is going to occur once the S&P 500 sells off to the 200-week moving average. This is the 5-year chart. Each one of these candles represents a week. And the S&P back in 2018, when the Fed was raising interest rates, it sold off until it hit the 200-week moving average. For the COVID crash, it actually fell well below it, but then quickly recovered and got back above that 200-week moving average. So if we are indeed, heading towards a recession and a bear market, this line, to me, I feel like large funds and technical traders are just waiting for this event to happen. They're sitting on a bunch of cash and they're going to deploy it. But why? Why potentially this month, the next 2 weeks, are we getting a nice bounce in the upward direction? And there's an interesting article from MarketWatch. I'll link it down below. But it's titled $250 billion in rebalancing inflows could rescue stocks by the end of June. This is according to JPMorgan. So while stock market strategists at Bank of America and Morgan Stanley grow increasingly bearish, JPMorgan's equity research department has churned up yet another bullish note for the bank's clients, advising them about the potential for a massive month and quarter-end rebalancing flows that could trigger a sustained rebound in stocks. Yada, yada, yada. What is going on? Well, you have to know what rebalancing is. This is Investopedia. Rebalancing is the process of realigning the weightings of a portfolio of assets. Rebalancing involves periodically buying and selling assets in a portfolio to maintain an original or desired level of asset allocation. So how I can explain this is many people deliberately buy either life cycle funds or target date retirement funds. Let's say you're in the 2050 target date retirement fund for your IRA or 401k. The asset manager is deliberately fixing your holdings for bonds and stocks at certain percentages. So for equities, maybe you're in large cap, small cap, and international stocks. And for bonds, you're in government bonds and corporate bonds. Well, the distribution, if you're retiring in 2050, this is arbitrary, but it might be 19% bonds, 81% stocks. However, if the stock market just went down 20%, you just lost 16% of, your equities in stocks. And by proportion, by ratio with bonds, because the bonds also didn't drop 20%, your asset allocation is no longer what the desired percentages are for your target date retirement fund. Now, these funds don't realign every day or every week. That's too much buying and selling. However, once a quarter, at the end of the quarter, they rebalance. So there are lots of large mutual funds with Vanguard, Fidelity, BlackRock, and all of their percentages are out of whack because the Nasdaq and the S&P has sold off so much this quarter. This quarter being, January, February, March, April, May, June. So at the end of the quarter, at the end of June, they start selling bonds in order to buy stocks to rebalance all of their life cycle and target date funds. So traders who are savvy and know how all these rebalancings and when they occur, they're either covering their short positions or they're buying back in, potentially giving us a bounce. And once again, over the next 2 weeks, I think we're going to hit this upper slope line before a bigger drop comes in July. Why am I so bearish about July? And I know this is just a single data point, guys, but I ordered a new MacBook Pro from Apple on March 18th, and initially it was 1 month delivery, 1 month turned into 2 months, 2 months is now turned into 3 months. They say it's shipped and it's coming to the store by June 10th, but March, April, May, June, 3 months to deliver and accept payments on a MacBook Pro that wasn't the default baseline model. So Apple has been really struggling with their supply chain issues and their manufacturing in China with all of the COVID breakdowns. And Apple and all the big tech stocks are giving their earnings in the third or fourth week of July. This is July 25th. So I don't want to be anywhere near these tech stocks this week when they report, because their year-over-year comparisons are going to be bad. Their next quarter guidance is going to be very weak. There's also just been a lot of bad news, I guess, recently for Apple. Because I currently have call contracts on Apple, I've been monitoring it closely. But here's a couple articles from Seeking Alpha. Apple's slowing App Store growth could lead to weak services revenue. This is according to Morgan Stanley. Apple to shift a portion of its iPad production towards Vietnam. This is once again because of the COVID lockdowns in China. Apple over the last 20 years has become way too reliant on China manufacturing, so they're trying to diversify to Vietnam. I mean, that's probably pretty good for Vietnam. I'm sure there's plenty of people that would love being in one of these factories making iPads. Apple to improve work schedules at retail stores, and this is all part of an effort by these large tech companies to fend off unionization efforts. So Amazon is going through this, Starbucks is going through this, people who work at Apple stores more and more are trying to organize and potentially unionize, and although I support workers, in general this doesn't help company earnings as much. Final article is Apple mixed reality headset likely to launch in 2023. To me, this is a disappointment. I was really hoping that Apple was going to get this VR, AR headset out before Christmas this year. Their fourth quarter is usually the most in sales because lots of people like buying gifts, but now it's not going to happen and their VR headset isn't coming until 2023. So when we look at the technical chart for Apple, it was looking amazing in 2021, and it peaked on January 4th, along with the S&P. The upper resistance line, this is a very strong line at 180. I don't see Apple getting above 180 anytime this year. It's been selling off hard the last 2 months, and there was a previous, I would argue, line of support here at 150. This is probably a new line of resistance. The next level of support going all the way back to September of 2020 is now at about $135 or $136. So if Apple breaks this line of support, it's just going to fall. If they have a really bad quarter, it's going to fall to potentially, I would argue, here. So let's copy and paste that and draw a green level. I would argue it's probably pretty strong here at 120. but if it breaks even 120, it's going down to 112. Because Apple by market cap is the largest company in the S&P 500, well, the largest company in the world now, the Dow Jones is going to sell off, the Nasdaq is going to sell off, all the ETFs are going to sell off. If Apple doesn't have a good quarter, the whole market is going to take a tumble. Nobody will be spared. But this sell-off on Friday, this was because of Tesla. Elon Musk fired out some interesting emails to all of his employees, and Tesla fell 10% over staffing and safety issues. Let's talk about the safety issue first, because I don't know exactly what this is about, but apparently the National Highway Traffic Safety Administration says it's filed a formal inquiry with Tesla over 750 owners complaining about their models suddenly and unexpectedly braking with no immediate cause. Those don't sound like accidents to me, so potentially I don't think this is going to deter many people from purchasing a Tesla. Their electric car is still by far the best electric car offered by any of the major automotive companies, so I don't worry about that. But Elon Musk in an email said he wanted to cut 10% of the white collar jobs at Tesla. So anybody making cars or earning an hourly wage, they're fine. It's the salaried people, in corporate offices, potentially. Now, lots of companies, it's bad mojo for corporate, office culture to, fire people, but more companies are just doing hiring freezes. They're saying if people want to leave, great, we wish them well, but we're not hiring any new people at this time. We'll actually see if Elon Musk follows through on this and starts letting people go. But it's interesting that the same week he decided that they needed to cut costs and reduce staff, he also announced that Tesla wants their execs in the office minimum in person 40 hours a week. I think given the remote work culture because of COVID in the last 2 years, and it was so hard for these tech companies to find talent that they just caved. They just conceded to their workers and said, if you want to work at home in your pajamas, we'll allow you to do that, even though the virus isn't as big of a concern right now. So I think Elon Musk is going to start forcing people to come into the office 40 hours a week minimum in order to weed out the people who might not really want to be there. Is this the best strategy from a CEO? I don't know, because there's lots of ways to measure, the value of an employee to a company other than are they physically in the office 40 hours a week. But I view this, once again, as Elon Musk just testing who loves the company the most, because if you are passionate about Tesla's vision and their business, then you'll show up to the office for 40 hours. So I think Elon is prioritizing loyalty to him and loyalty to the company over potentially the top talent and the best producing workers, because there's other metrics you could evaluate somebody on, even if they just work remotely 100% of the time. As an introvert myself, I'll go ahead and admit if I had to physically go to an office and work 40 hours, I wouldn't be as productive because offices are very distracting places. I'm much more productive just getting my work done in quiet at home with no people or other distractions, but Elon can do whatever he wants to do. Let's check in with the technicals of Tesla, and there's probably a very strong line of resistance up here at $1,200. I don't see this being broken anytime soon. As long as the Fed is raising interest rates, I'll go ahead and call the shot and say Tesla's not getting back above $1,200. In the short term, there's probably another level of resistance now forming at $900. Sellers will trigger, sellers will step in if Tesla in the short term rebounds. But there does appear to be a very strong level of support going all the way back to December 2020 at this $700 range. And potentially this could hold, but Elon said he wants to, start getting rid of people because he has a super bad feeling about the economy. It's not very technical language for, hey, the Fed is raising interest rates. People might have less money to buy a new car, buy a new Tesla. And at the end of the day, I don't get involved with Tesla because their valuation has never made sense to me. I love the company, I love the product, I want to buy a Tesla someday, but that doesn't mean you should pay any price for their stock. Currently, and Tesla's already one of the largest companies in the world by market cap, currently their price to sales is 14. And even with their tremendous revenue growth, I still just can't justify these ratios or these multiples. Tesla is still diluting their shareholders. So, what this means is that at the end of the day, I understand there's lots of future projects that will, make Tesla a fantastic company in 2030. But today, they're a car company that sells cars, and if global demand dries up because of a global recession and people don't want to buy cars or pay as much for them, then yes, Tesla's share price will fall, and it probably will go down to close to maybe 500 or 400. I think these are the next nice round numbers that Tesla will bump into and find levels of support. And who knows, if their revenue continues to grow and the share price continues to fall, I finally will say this looks like an attractive buy at this time. Going back to the S&P though, I think this convergence is going to occur where the market potentially might bottom out in August or September. I think the S&P, the technicals, it's going to keep downtrending until, once again, it hits this level of support, the 200-week moving average. And as long as, we don't enter World War III or something catastrophic, I think buyers will step in because the American economy is still doing very well. Yes, I think to get inflation under control, rates have to go up, unemployment will go up, there will be a contraction of the GDP. Will it be anything like 2008, 2009? I don't think so. I think 2 years from now, whatever will come out of it, and all these companies will be roaring again, and the S&P will be back at all-time highs. Okay, everyone, that's all for this update video. If you know something I don't, let me know in a comment down below. I love hearing from you guys. Also, give this video a thumbs up. Really helps out the channel. Till the next video, take care.